Howdy, Jacob here. Today we're doing a one-off video for Kratos Defense Security Solutions in the aerospace and defense industry. 2.4 billion market cap on just under 2.6 billion enterprise value, so a little bit of net debt. Company's been around since 1994. Profits have been very low. We can see the operating profit. The greatest operating profit of the last 10 years has been 5.7%, but is hovering in the very low single digits, which affects their return on invested capital being as low as it is. Their gross margin, however, has gone up 2% in the last 10 years, and revenue is up about 30% over the last 10 years. So not a lot of growth here, but if you minimize it to 2016 to 2023, there is a bit more growth. Let's see if there's any devastations, and it doesn't look like it. So it looks like just a decline in demand likely for their products. Balance sheet perspective, 73 million cash on hand with 219 million total long-term debt. So that's about 150 net. And their production of cash flow is not really there. As high as 13 million in the last 5 years, but also negative 71 million. And free cash flow is the production of cash, and so that's the lifeblood of the business. That's how you actually get to pay for acquisitions, reinvestment, share repurchases, debt pay down, or dividends. And it looks like they just haven't averaged a positive amount in the last 5 years, positive free cash flow, and so looks like to make these acquisitions, to pay down that debt, they're issuing shares. So we can see that shares have over doubled from 58 million to 130 million shares outstanding. So let's start making some assumptions here. I'm a little turned off by that. Revenue growth. Recently they've been growing a bit higher in inflation, so maybe I'll put 5 there. And then 14 on the PE price for cash flow, because I don't think they deserve any sort of premium with their low margins and low return on invested capital. And then I'll just do an average here, maybe 2.5, 1.5 share change. They've been issuing a lot of shares. Yeah, it looks ugly here. So it's really just their margins are not there. And although, 150 million doesn't sound like a lot of debt for a company that's worth 2.4 billion, but they just don't produce free cash flow, and I care about free cash flow more than absolutely anything else. So, short video. Hopefully you enjoyed it. Have a good one.